Welcome! In this video, we'll turn your first $6,000 investment into a smart, simple plan that avoids costly mistakes and sets you up to beat many pros over time. We'll move step by step, secure your foundation, choose the right account, pick a low-cost index fund, and automate your path. We'll also include quizzes, diagrams, and a clear comparison of doing it yourself versus paying an advisor. Let's get started. Agenda. First, we'll confirm whether this money should be emergency savings and how to set that up. Next, we'll cover why the Roth IRA is a powerful tax wrapper for long-term savings. Then, we'll choose a low-cost index fund that fits moderate risk. After that, we'll walk through opening and automating the account. We'll examine how fees compound against you and compare DIY indexing to hiring an advisor. Finally, we'll wrap with key takeaways and your action plan. Before investing, confirm that your $6,000 is not emergency money. If it is, prioritize 3 to 6 months of living expenses in a high-yield savings account. Liquidity matters more here than minor yield differences. This safety net prevents you from selling investments at the worst times to cover unexpected expenses. Here's the logic. If you don't already have an emergency fund, build 3 to 6 months of expenses in a high-yield savings account. Choose quick access over yield because the purpose is safety and liquidity. Automate transfers each paycheck until you hit your target. Once you do, you're ready to invest the surplus and let it grow. Quiz time. The question is, how much should you generally keep in a high-yield savings account before investing aggressively? Options: 1 to 2 months, 3 to 6 months, 12 months, or whatever is left after investing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 3 to 6 months of expenses. This cushion helps you avoid selling investments during emergencies and protects your long-term compounding. If this money is for retirement and you have earned income, the Roth IRA is often the best place to start. You pay taxes now, the investments grow tax-free, and qualified withdrawals in retirement are tax-free. This structure typically outperforms a standard taxable brokerage account for long-term savings, assuming you're eligible. Always confirm current contribution and income limits for the year you're contributing. Mechanically, you contribute to a Roth IRA with after-tax earned income. Inside the Roth, you buy a low-cost broad market index fund. Over time, compounding occurs without ongoing tax drag. In retirement, qualified withdrawals are tax-free. This combination of tax-free growth and tax-free withdrawals is rare and very powerful for long-term investors. To open a Roth IRA, pick a reputable brokerage that offers zero-commission trades and low-cost index funds. Open a Roth IRA and verify you meet eligibility and contribution limits for the current year. Link your bank and fund the account. Purchase a low-cost S&P 500 or total market index fund with an expense ratio at or below 15 basis points. Turn on automatic investments and dividend reinvestment. Finally, secure your account with two-factor authentication. This table compares common account types. Roth IRA. You pay taxes now, then enjoy tax-free growth and qualified withdrawals. Contributions may be accessed, but earnings have restrictions before retirement. Traditional IRA, contributions may be tax-deductible depending on income and plan coverage, with withdrawals taxed later. Taxable brokerage, no special tax treatment. You'll pay taxes on dividends and realized gains, but there are no income or contribution limits, and you have maximum flexibility. For moderate risk and simplicity, a broad index fund that tracks the S&P 500 or the total U.S. stock market is a strong choice. Prioritize very low expense ratios, ideally 15 basis points or less. Choose funds with high liquidity and long, consistent track records. Avoid sales loads and excessive turnover. For most beginners, a set-it-and-forget-it approach outperforms frequent trading. This timeline walks you through the first 90 days and your ongoing routine. On day 0, set your emergency fund target. In the first 2 days, select a brokerage and open your Roth IRA. During days 3 to 7, link your bank and transfer funds. Around day 7, buy a low-cost broad index fund. Over the next month, enable auto-investing and dividend reinvestment. By day 30 to 90, confirm your allocation and verify your expense ratios are under 15 basis points. Each year, increase contributions, rebalance if necessary, and update beneficiary and security settings. Every 3 to 5 years, reassess risk tolerance and goals. Fees compound against you just like returns compound for you. A 1% annual fee can reduce your ending balance by a significant margin over decades, compared with a near-zero cost alternative. Aim for expense ratios at or below 15 basis points for core index exposure. Prefer index funds or ETFs with no sales loads, minimal tracking error, and strong liquidity. On the left, do-it-yourself indexing means buying low-cost index funds and automating contributions and rebalancing. Costs are typically a few basis points. You retain full control and capture most of the market return after minimal expenses. On the right, many advisors place clients into similar index funds, but layer an advisory fee of 0.5% to 1% of assets annually, plus the fund's own expense ratio. This additional drag can erode decades of compounding. Unless you need complex planning, DIY indexing is often sufficient. Second quiz. The question is, for a beginner's core index fund, what is a reasonable maximum expense ratio target? Options are 0.05%, 0.15%, 1.25%, or 2%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 0.15%. Keeping your expense ratio at or below 15 basis points preserves more of your returns for compounding over time. Key takeaways. Build an emergency fund of 3 to 6 months in a high-yield savings account. For retirement, a Roth IRA often offers superior long-term tax treatment. Choose low-cost, broad-market index funds with expense ratios at or below 15 basis points. Automate contributions and reinvest dividends. Over the long term, simplicity and low fees typically outperform complexity. To conclude, secure your base with an emergency fund so you can invest with confidence. Use the Roth IRA wrapper when eligible for long-term savings. Own the market through low-cost index funds. Automate your process, review annually, and keep fees as low as possible. Disclaimer. This video is for educational purposes only and does not constitute financial, investment, or tax advice. Investment returns are not guaranteed, and past performance does not predict future results. Verify current year Roth IRA contribution and income limits, and consult a qualified professional for personal guidance. Here is a simple resource checklist. Ensure your brokerage offers very low-cost index funds and zero commissions. Confirm Roth IRA eligibility and check current year contribution limits. Select a target index fund that tracks the S&P 500 or the total market with an expense ratio at or below 15 basis points. Turn on automated contributions and dividend reinvestment. Secure your account with a strong password and two-factor authentication. Thanks for watching. If this helped, please like the video, share it with a friend who is starting their investing journey, and subscribe for more simple, high-impact money guides. In the comments, share how you'll allocate your first $6,000 and any questions you want covered next.